on these roadshows. But we are in a very interesting period, and we just got a notification that President Ramaphosa will be addressing us again this evening. And if you look at the trends globally, everyone is moving to a lower level of lockdown and realizing that the economy and society can't remain shut forever. And it's more about managing the process and managing the virus rather than trying to hide permanently, because it's just impossible to function on that basis. So I expect some level of relaxation and a step down, which probably will start this evening. I'm assuming many of you will have the slides in front of you, so I'll just start off with the long-term performance. If you look at the graph, since 2007 versus the STEFI benchmark, the fund has been able to outperform over the long term. But on the quarterly and one-year numbers, given what happened in March, there's obviously been a step down given the dislocations that we've seen in the market that occurred in March, some of which has begun to unwound. But it's going to be a relatively long road to recovery. Even once you begin to reopen, it's about repairing the damage which has been done. And it's not going to be a full back to normal, but it's going to be there's going to be stops and starts, and the economy will need a lot of support in order to get through this process. So let's start with get the bad news out of the way and start with the performance of varied asset classes in the first quarter. That's slide 3. You can see that the contributors to performance, the quarter we had a negative return of minus 1.9%, far and away the worst quarter we've ever had. But it was a quarter where you did see serious dislocations and asset prices falling to levels, which were out of the bounds of what kind of you would have normally expected, and the way you set your allocations. So offshore, obviously, with the rand moving out, was a positive contributor. SA cash, we've had a decent amount in money market. It should have been a bigger contributor because ideally you should get around 2% contribution from that component. But given the nature of the offshore component, of the domestic cash component, and the rise in spreads from about an average about 1.4, 1.5% to close to 2%, that had an offset and diminished the return on that very conservative component. But obviously, because the spread is now wider, the potential return going forward has actually increased. SA bonds were a negative contributor, so we had about a 10% bond allocation. But given the extent of the bond sell-off, that was a detractor, and it didn't offset the higher yield on that bond component. And then, interestingly, on the fund, two of the bigger detractors on the fund were relatively small components. So property was around a 2% component of the fund, but it managed to, because of the sharp drop in the property sector, it was a minus 1% driver. And then preference shares were about a 3.5% component, but because they fell by over 30%, that was a 1% drag. So unfortunately, if you look at the total drag on the fund, it was the relative small components of the fund which were some of the biggest drivers of the negative performance. Whereas the majority of the fund, 95% of the fund performed adequately, it was these small components which fell quite dramatically. That's presented in slide 4, where you can see that there were quite big moves. And obviously, the all bond index, minus 8.8%. Those are sharp moves for SA government bonds, but the property and preference share moves were really, quite extreme. Even though the fund had relatively small positions in that, they were big detractors. Where we did have a reasonable position in a 10% bond allocation, which we viewed as reasonably conservative. If you look at slide 5, the bond sell-off was the most extreme we've seen over the last 3 decades. So if you look at the percentage change in the government bond yield, it was far greater. It was almost 30% change in government bond yields. It was higher than Nene Gate, higher than the taper tantrum, substantially higher than those, and it was paralleled with the Asian debt crisis of the 90s in terms of the extreme sell-off we experienced. So, I think a lot of that is, a lot of that sell-off is temporary in nature, and you've seen a decent recovery. So we didn't cut any allocation, at these points, but we did. You've seen that recovery come through in the fund, where that 10% bond allocation, a lot of that has recovered. Now, I don't think we're out of the woods yet. If you look at our fiscal position on slide 6, you can see that going into this crisis, we were in a relatively weak position. So our growth dynamics over the last few years with sub 1% growth and our deficits of 5 and 6% were pushing the budget up, on a debt ratio from 55 to 60%, and we were forecasted to hit around 70% over the next 3 years. Now, what the COVID crisis has done is that has put a step change, and if you look at JP Morgan combined with Treasury forecasts, that 70% is likely to be 80%, and we do need some aggressive action now in order to curtail the deficit and flatten out the trajectory. So we will have a step change, but the question now is whether we can flatten that trajectory and whether we see some plans in place in order to do that. Now, at the moment, there's talk of a recovery plan of 100 billion rand. I know that someone put in the Daily Maverick had 1 trillion rand. I think obviously people are throwing around big numbers, and they're looking at what's happening overseas in terms of what countries are doing in order to help deal with the crisis. But we do need some sort of program in order to help the economy go through. But the question is what type of reform and structure you can put in place such that it enables us to flatten the trajectory after this. Because if you look at slide 7, we did go into this as one of the more fragile countries in the emerging market complex. Our growth, is amongst the lowest alongside Mexico, and our budget balance was amongst the worst. Ourselves and Brazil had the highest, already running quite significant fiscal deficits. And you've seen that in the FX performance. It has been a massive depreciation year to date of the rand, and there's been a real flight to safety in terms of the dollar being the global reserve currency, even though the US is experiencing its own financial and economic crisis. Our policy response alongside other emerging markets has been very aggressive in terms of the lockdown, and we're going to see some sort of financial policy response, but we'll have to assess what is the efficacy of that response and how much it can help transition the economy while we get out of lockdown. The reality is no country can function under lockdown, so it's rather how we manage that transition and how we manage the reopening of the economy, which we've seen globally is starting to do. And the better we're able to manage that, the better the economic outcomes for everyone. In terms of portfolio positioning, we have SA cash and money market being a large component of the fund. Inflation-linked bonds at around a 5.5% component, but that is an area where we have been adding. We think that's a key asset class in South Africa, which structurally you'd look for a higher allocation. If you look at where real yields were, they've been coming from very low levels, and they weren't really pricing in South African level risk premiums, and that's why we were very hesitant to be adding. You've seen real yields move up from sub 1% to around the 2.5%, and they're now around the 4% level, and that's an area where we're seeing a lot of value. And just in the last week, we've been adding a lot of that, because we do have a good cash component where we can take advantage of higher real yields to add to that. We've been as high as 20% in this fund, and I envisage we are going to add a good component to inflation-linked bonds in the coming months. On SA bonds, 10% of that is South African government bonds. The other, 25% is hedged into floating rate assets, so that doesn't have an interest rate risk. On the preference share side, that's a floating rate component where we are getting 12 and 13% on the big four banks. It has come under pressure, but we haven't sold any of that. We do think that at these type of levels, it offers a very attractive return outcome. And if you do see a stabilization, then that 1% capital loss, which the fund suffered, we think that can reverse. On the property side, also there we haven't necessarily sold. You've got a very high yield contribution, and we do think that it's a real asset, and as the market stabilizes, you can get a recovery there. And on the foreign cash and bonds, this has come under pressure. We have been conservatively positioned, but even there, given the extent of the spread retracement, our weighted average term on our offshore component is just 1 year. And on a 1 year component, we're getting a dollar yield of around 12%. So that area of the fund has a great return potential going forward. So overall, with a duration of 0.8 years, it's relatively conservative. The fund yields at around 8.7%, so it has increased by about 100 basis points. We have maintained the property, the convertible and the pref share component, as well as the offshore assets. We have, we increased that early in the quarter. So we increased the offshore component from about 3.5-4% out to about 6.5%. And with the rand moving out quite aggressively, we have been putting hedges in place on that component, but we haven't sold it aggressively because it is a good risk offset against the rest of the fund. So overall, still reasonably conservatively positioned, and a reasonable level of offshore assets which offer a high yield, but and the components of the fund, the property and the preference shares, we haven't sold, and we do think the forward returns on those components are quite attractive, and that's why we've held on to them, because we do expect a capital recovery in the short term on the preference shares, and then over the medium term on the property component. If you just look at the breakdown of the yield by the different asset classes, that's slide 9. You can see that the foreign component around 6.5%. So that's driven by the offshore bond component, which has about a 10 to 12% yield. On preference shares, around 12%. Property around 18%. That's a trailing yield, so obviously we don't think that, given what's happening in the property sector, that's going to be delivered in terms of dividends, but it gives you an idea of the extent of the sell-off in the property sector. And if you look at even a 50% ratio, you're still getting around 9%, and then a recovery over time, just giving you an idea of what the potential yield on that is. On the CLN component, with a high degree of credit quality, that's about 9.5%. On fixed rate bonds, it's about 9%. It's close to 10%. Floating rate on close to 8%. And then inflation-linked bonds, that's actually increased since the slide was done. So we're looking at about an 8.5% yield on the inflation-linked bond component, and that's an area where we've been adding. SA money market and bonds, obviously, given the interest rate cuts which have come through, that's diminished somewhat, but it is a very low risk component given, and to get 7% on a low risk component, we think that that's a reasonable return level. And then overall, the fund yield has increased to about 8.7%. It will if go down over the next 3 months as floating rate assets reset. So we expect about a 30 to 40 basis point reduction in that over a period of time as assets reset, given that the SARB has cut rates. We do think that rates in SA, our rate cuts have been far more aggressive than other emerging market central banks. And, given the move in the Rand, you've seen about a 35% drawdown in the Rand on a year-to-date basis. It's questionable whether the SARB can continue cutting in that environment without putting the Rand at serious risk. So, we are at 4.25 on the repo rate. That component of the fund, we expect about a 30 or 40 bips, reduction in yield over the next 3 months, bringing the weighted fund yield down to about 8.4%. And we think that given where spreads are, it's relatively attractive, going forward. And then the last thing is we do have a component of land bank in the fund just under 4%. And there we've seen, the news that land bank on its facilities, it's basically unable to pay its facilities. And that's a reflection more on a liquidity constraint and a short-term funding constraint. And they will have to draw down on the 5.7 billion Rand that was given to them in the form of guarantees in the recent budget. Now, our view on land bank is that it's a critical SOE for South Africa. So it funds the agricultural sector, and therefore the land bank can't afford to fold. Secondly, it's been given guarantees just in 5.7 billion Rand in the February budget, and on a total book size of about 43 billion, you can see how aggressive the government has been in terms of supporting the land bank. And we don't think that in the context of the size of SOEs, a total book of 40 billion Rand is going to put significant strains on the treasury. It's effectively just 1 week, in terms of the government, in terms of the guarantees, it's just 1 week of government bond auction. So in terms of the size of the problem for Treasury, it's one of the, I think it's the least of their problems at this point in time. The key problem for the land bank is the short-term liquidity issues, and they have, if you look at compared to 5 or 6 years ago, they had around 70 to 80% short-term funding and 30% long and 20 to 30% long-term funding. They have reduced that 80% down to 60 and in around 2 years ago, and they're currently down to 50% short-term funding and 50% long-term funding. But that's still not a great position to be in. Their plan was to move from an 80% short-term funding all the way down to, their plan was to move from 80% short-term, 20% long-term to 80% long-term, 20% short-term. Now they have got halfway there, but obviously this crisis has basically stalled that funding strategy, and they are in a position where they have 50% short-term funding and 50% long-term funding. Now, given what's materialized, they obviously having constraints in order, in their collections, and therefore they will have to draw down on that facilities and will have to draw down on the guarantees. But in terms of a solvency issue, we look at the entity as being 100% state-owned in a critical infrastructure, and therefore the Treasury won't hesitate to add additional guarantees where necessary, and the quantum of those guarantees are not significant in the context of a 3 trillion South African government bond book. So we do expect action from them in the near term, and they will be negotiating additional guarantees and negotiating with their revolving credit facilities in order to reduce this technical issue. So I'm sure we'll get news in the next couple of days, but it's not something we are particularly concerned about at the moment. I think there are bigger issues, and this is a 100% government entity. So with that, Doug, I'll hand off back to you, and we can go to what questions you've got from the audience.
Okay, hi Rashaad. Thanks very much for that. While we're on the topic of SOEs, do you feel the SAA's removal from, or potentially the SAA's removal from the SOE question will go some way to helping the government rectify its public finances?
So I think the finally coming to a resolution on SAA will be the first thing is it will stop being a drag on Treasury. So SAA has been a drag for the last 2 to 3 decades. It was never a functioning entity, and essentially it was a drag of 5-6 billion rand a year. And when things were okay, maybe you could just throw that money down the drain, but we have reached the point where you can't afford to be throwing that type of money away for an entity which only employs about 4,500 people in South Africa. Unfortunately, we've seen a lack of willingness. So even though Tito Mboweni was very adamant in January, February that he wanted to shut SAA down, unfortunately, when they presented the budget in February, the cabinet opposed it. And that was a signal that Treasury wasn't able to get the reforms that they wanted through, and Treasury and government and cabinet hadn't really absorbed the seriousness of the problem. So we were looking at SAA as a sign that they are reflecting on the seriousness of the problem and the willingness to shut down SAA and shut that drag down and swallow that 15 or 16 billion rand of loss, which unfortunately we have to do. There's no getting around it, but at least it stops this continued drag on cash from the fiscus, which we couldn't afford in the last few years, and we definitely cannot afford now. So we're looking at that as a signal for how they're going to deal with some of the tough issues which South Africa has to face going forward. Doug, are there any other? Are you looking at the questions?
Hi, Rashaad. So we also have another question here on the foreign bond allocation. So maybe you could just talk us through that, and then I guess while you're on that, just explain how you've hedged out the currency exposure, because that is different to the physical exposure.
Yeah, so we've got about 17% in offshore assets, and we've hedged around 10% back. So we're actually increasing the hedges in the last few days, but effectively you're sitting with an FX exposure of just under 7%, and which has helped in terms of offsetting some of the risk positions. Now, what we hold in that offshore component is a range of SA assets, including South Africa's dollar government bonds, bonds issued by the likes of Naspers, Old Mutual. We do have a component of Eskom dollar bonds there, which are yielding around 16% in dollars, and they mature in about 9 months' time. So a very attractive return component there. Assets like Remgro, Redefine International. So a range of SA-related assets with a weighted average yield of around 12% in dollars. So that component, if you hedge it into rands, we're getting roughly around 16% rand return on that offshore component, which is relatively attractive, and we hedge that through futures forwards, and also sometimes we use option overlays where we buy put options on the rand and sell the call. So the recent overlay we did, we bought a put option on the rand at around the 18 level. So that means that if the rand rallies below 18, we've got some protection on that, and we've sold calls at the 22 level. So if you look at how if you look at the movement in the rand and the panic, we're able to get a very attractive return profile where we can participate in rand weakness, where it is at the moment. It's sitting close to 19 at the moment, but we can participate in rand weakness all the way to the 21 level, and we get protection in the case that the rand rebounds and rallies back below the 18 level. So we have begun at the 19 level to trim some of that FX exposure, but it hasn't been as aggressive as previous incidents. Well, previously, once it got to the 18, we previously got close to 18, we were very aggressive in hedging the currency all the way back to around 1%. This time we have been a bit more cautious because we realize that there are more fundamental risks and we don't want to give up on that component of that FX. But the extent of the move does mean that we do believe it is prudent to be instituting hedges in place. And there's a lot of risk premium being priced into the Rand market at the moment, and we do need to capitalize on that.
Great. And I think just to remind everyone there that the actual currency exposure in the portfolio is about 5.8% to the USD. Rashaad, just a final question. Maybe you could just touch on the SARB's rate outlook and what your expectations are there in terms of another rate cut, and then just your view on the Rand and where the Rand could potentially go.
So in terms of the SARB, I think I mentioned it before, we are in a new monetary policy paradigm because historically the ability of the SARB to cut was very much constrained by what the currency was doing, because they are responsible for protecting the value of the currency. Now, for them to have cut 200 basis points in an environment where the Rand is weakened around 35%, that shows you how extreme their move is and how extreme their reaction is given what's been going on. And they are willing to depreciate the Rand and support the economy through rate cuts in order to basically offset the economic weakness. So in a currency war, what you try to do is devalue your currency and export your economic weakness to the rest of the world. So that's effectively the strategy they're trying to do. I think that it's, you don't want to do it such that you diminish the belief in the value of the currency. And I think further rate cuts from here will be quite limited because if you look at the spread, firstly, the spread relative to US rates is now at close to record lows, and relative to EM rates at the front end is at record lows. So we have been very aggressive in terms of rate cuts. And I think if you do any more, you are, impacting the kind of credibility with which you, in terms of the protection of the value of the currency. In terms of the valuation, at 19 to the dollar, we are very close to the 2 standard deviation undervalued level, which is around 28-29%. So we are at about 25% undervalued. If we get to the 1950 level, it would mean we are 2 standard deviations undervalued, and then beyond that, it takes quite extreme incidents. If you look at the 98 crisis in terms of and the 2001 Rand crisis, those were the previous extreme events. And if you put a 2.5 standard deviation move on where we are, and you look at a rolling PPP, that would put you at about 21, 22 to the dollar. So for us, that would be the extreme event, which would, dictate an unwind of this. And, we are very close to that level. We are about 10 or 15% away. We're saying, even though the Rand is quite stretched at 19, it's not impossible to get up to the 21, 22 level, but we think that will be the historically where it has got very reduced from that point, see a very sharp recovery. So we're not ruling out a move to that level, but at 19 to the dollar, it is very close to that 2 standard deviation level. And if you do see evidence that the economy is reopening, that the global economy is evidence that the global economy is normalizing and reopening. So we've seen that in Germany, we've seen that in the US. I don't think it's going to be a smooth recovery, but even a stop-start type of recovery, that will provide some support to risk assets, of which the Rand is one of the key risk assets in the global in EM and the global economy.
Okay, we have quite a few more questions here. I'm just weary of time, but Rashaad, could you maybe just comment
I'll comment on them quite quickly.
Okay, cool.
Yeah.
Could you just comment on the SA bond exposure, so South African government bond exposure in the fund, and your views on that.
So, from an income perspective, we've held around a 10% exposure. That is a neutral type level. What obviously the extent of the sell-off I showed earlier was, a record move in terms of yield, and it was a drag on performance. We believe that the move and the dislocations you saw in March were quite stretched, and therefore we didn't sell any of the bonds. And as you've seen the yields recover from around the 13% level, close to around the 10, the fund has benefited from that recovery. Now, going forward, we will be assessing what is a neutral type level for exposure for an income fund, given the fiscal outlook, and do we need to look at assessment of what is the fair value type of yield, given what the outlook for South Africa is? Now, historically, our fair value yield was around the 9% level. Bond yields now at the 9.30, 9.40 level are still cheap relative to fair value, but we have to now give an assessment of what fair value is, given the fundamental shift that we're seeing and the fundamental increase in the debt stock. We need to look at what that is, and whether if the fair value has increased, then any type of bond rally close to the below 10% or the 9.50 level will mean that we lighten our exposure from that 10% level and we move to a more conservative positioning. I don't think it made sense not to panic and reduce that exposure significantly, but it's something that we will be assessing. What is the neutral level and what is the fair value of bonds given the new trajectory? And we will assess that going forward, and we won't hesitate to either put on hedges or reduce that neutral exposure, maybe down to a 5% level or 7% level, and take advantage of some of the quantitative easing that SARB is using, or some of the rally that's materializing in order to do that. So the answer is we have a 10% allocation. We believe that's around neutral, but we will be assessing whether to reduce that, given that the fair value yield for bonds may be structurally higher than it has been historically, and we do need a higher risk premium.
And some of that position as well has been slight, or some of the risks in the SA bonds have been hedged to some extent through an increase in your offshore allocation and via the increase in allocation to inflation linkers. So just to make that clear as well. Last question.
Sorry. The last week or two is inflation-linked bonds. 4% real yield. You add inflation of around 4%, that's 8%. Our average yield at the moment on linkers is around 4%, and we are adding to that. And we think where we do see value in the bond market, that's the place to be. And effectively, what we'll be looking to do is transition from nominal to inflation-linked bond exposure, in the coming months as the opportunities present themselves.
Okay. Final question, Rashaad. Just on the liquidity of the portfolio, can you maybe just touch on your views around that?
Yeah, so that's an area where, we have been relatively conservatively positioned. We've got about a 15%, cash component in the fund, which allows, a lot of room in terms of liquidity and managing flows, and there haven't really been much flows in the last month. We've also got an offshore money market component, which is highly liquid, which of around 6 or 7%, so over 20% in terms of, just core liquidity, which we can access within 24 hours. We do have a 15 component to senior bank NCDs, which are highly liquid and are, giving us attractive spreads of around 150 basis points with daily liquidity. So if we need to sell those in the market, we've got a highly, those are highly liquid assets. So in my mind, 35% of the fund is has a high degree of liquidity. And then also, if you look at the weighted average term of the fund, that we've been reducing for now a number of years. Historically, the weighted average term, if you look at both the domestic and offshore component, has been around 3.5 years. It's currently sitting at about 1.7 years. So the weighted, average maturity of the fund has been reduced, quite substantially, and we've spread those maturities out, and we have believed over the last 2 years that it is more prudent in an income fund to run with a lower weighted average maturity. So we have brought that down. If you look at a weighted average maturity of 1.7 years and a liquidity component of 35 years, that means if we do nothing, this entire fund can liquidate, in just 1.7 years. So that is a very conservative liquidity position, but we do think it's prudent, in the current environment, given the risks in the global economy in South Africa. So from a liquidity perspective, we think we are very well positioned in this space.
Sorry, Rashaad, one last question that we've got in is just around the South African property sector. There has been a lot of press around REITs suspending their dividend payouts, distributions, and I guess the concern is it worth holding property now when you're expecting no or very little income distribution in the future?
Yeah, so I mean the question of selling at these levels, we definitely don't think it's worth selling at these levels. But now the question is, when do we look to add? And there we've also been reasonably conservative because, as you said, properties, these companies have suspended dividends because their rental income, if you look at their collections, and that's what we've been paying a lot of attention to, in the last few weeks, and we've seen, data come out of one or two companies that they're basically collecting about 60% of their rent at the moment. Now that is, a big fall. Obviously, they're used to collecting close to 100% in the high 90s of rent. So a fall to 60% is quite massive. And obviously, if we do get as the lockdown continues and we slowly come out of lockdown, we do expect a normalization of that, but it will be, very difficult. If you look at the sectors, office and retail, we're not going to see a move back to 100% immediately, but they do need to service their debt. So they are in a precarious position. But at the end of the day, if you have to look forward, property is not a 3-month asset. It's a long-term, it's a perpetual asset. And as the lockdown normalizes and their collections normalize, it is a real asset. And if you do look at the potential inflation protection properties of property, we do think that it's a trade-off between the short term where you're not collecting rental, the negative of the short term, versus the positive of having a long-term real asset, which it provides an inflation hedge. So we do think that at some point, it makes sense to add a bit to property, but it is risky in this environment. We have been talking about the economic constraints, and therefore it won't be an aggressive component of the fund, but it will be one where once we see a normalization, we may look to add a little bit, maybe take it up from about the 1.5% level back to the 2% level in the fund. But on a very conservative basis, given the headwinds the property sector is facing.
Okay. Rashaad, we've just had a clarification question on the liquidity side of things. I guess the question I asked Rashaad was about the liquidity of the portfolio. Granted that investors do hold stakes within the portfolio, not within specific instruments. But Rashaad, are you seeing much illiquidity or liquidity concerns on some of the more high-yielding debt instruments in the fund?
So, I mean, in the offshore market, so let's just look at the offshore market versus the local market. The offshore market trades a lot more frequently. So when you see a sell-off, it materializes in pricing very rapidly, and then liquidity resumes, but at a lower level. So the offshore component of the fund was yielding about 6 or 7%. That yield has re-rated to about 12, 13%, but it has led to a price fall. So there you have high liquidity, but capital on that offshore component has been affected. But in lieu of that, you are getting a 12% dollar yield to compensate for that. What happens on the local side is that pricing is slow to adjust, and corporate bonds, they have moved up around 30 or 40 basis points across the fund, but in the market, some assets that other people have, that the market's been holding, that those yields have moved up around 100 to 150 basis points. But the question is, maybe the move should be at 150 to maybe even 250 basis points on certain assets, especially subordinated, new style subordinated bank debt, which the fund doesn't hold. So there are assets which have marked up relatively slowly in the SA market, but it is coming through. It has been coming through in the last few weeks. Now, if you look at our fund with a 1.7 weighted average term on the local assets, a high level of exposure to bank NCDs, etc., and a high degree of credit quality on the corporate components that we have, and no sub debt, we're not really concerned that we need to see a significant move up in the spreads that we have. We've already seen around a 40 basis point move up, but we don't think that in this environment we need to see much more on that, because we are getting an average spread now of 200 basis points. But in terms of if people are looking at their holdings, when you're looking at lower quality corporates where the yields have only moved up 150 or 200 basis points, if you're looking at subordinated debt where the moves have been 150 to 200, you may see further downside on those components. So one must be wary of what's one holding, of what the holdings on the funds that you have, especially in terms of tier 1 and tier 2 bank debt.
Okay, thanks Rashaad very much for taking the call. Really appreciate your time. Just for everyone who is on the call, look, we are aware that there have been some issues with people seeing the presentation. We do apologize for this. It seems to be a connection issue with Skype. But what we will be doing is this discussion has been recorded. The presentation is available for distribution. And if you do want it, we will try and to our best of our knowledge based on the call to email out the presentation to everyone. But if you do not receive it in the next day or two, please feel free to reach out to your business relationship manager, and they will be happy to send it to you. So thanks again to everyone for taking the time, and we hope you found this useful. And just to let you know that there will be another one of these calls tomorrow morning. Thank you very much. Goodbye.